Welcome to the AWA Market Minute, breaking down financial, political, and economic events that impact today's retirees. Our investment committee performs hours of research and market analysis every month so that we can share simple summaries with our clients in 30 minutes or less. Featuring top industry experts who share insights on important topics so that our clients can gain understanding and peace of mind on their journey to and through retirement. And now your hosts, Chief Investment Officer Scott Hoxer and Founder and CEO Paul Coles.
Well, hello everyone. Welcome to this month's edition of our AWA Market Minute. I'm Paul Coles. With me, as always, is our co-host Scott Hoxer, Chief Investment Officer of our firm. We're happy to be here with you guys today. Yesterday was Valentine's Day. It's kind of an exciting time. Did you give Marcy anything special?
I did. Our kids kind of commandeered the night as they usually do, but we did have a fun night with the kids.
I think it's interesting how Valentine's Day has evolved into a family day.
Yes.
We did the exact same thing. We went to a basketball game and did a big family dinner, and which we have a good time doing. It's fun.
We did too.
So this year for Valentine's Day, I gave my wife a couple of 1099s. Worked on a 1040. This is kind of that time and season where we start piling in all of our tax documents and kind of start circling the calendar for tax preparation. And we get a lot of questions this time of year from our clients on tax advice. And Scott and I, we're investment advisors and wealth planners and strategists. Obviously, we understand how taxes work, but we're not tax accountants. And so we thought, as we kind of fielded some of these questions today and talked through some of the best practices and tips for 2024 taxes, that we'd bring on a professional. And Scott, why don't you introduce today's co-host?
Absolutely, Paul. So we have the privilege today of being joined by Jon Shaw. John's a enrolled agent and a principal at Shaw & Nielsen, which is a top-notch accounting firm. And pleasure to have you with us today, Jon.
It's great to be with you guys. Yeah, thanks for having me on.
Absolutely. So, Jon, we had a lot of great questions this time of year, and they're one of the things that we always like to tell people is it's good to have these questions as tax season's going on. It's even better to do a lot of this planning in November and December. That's how we know we're getting everything organized. So in the spirit though of everybody kind of getting a little bit geared up for tax preparation for April, we do have a bunch of conversations we want to have today. I think top of that list that I'd love to jump in with is conversation we get a lot on kind of some of the changes that we're up against. So we've seen a couple updates this year with some tax law. What are some of the big numbers and changes that you've seen, Jon?
Well, right now, nothing changed from last year to this year on the tax, except for the brackets went up a little bit because of inflation, right? And Social Security, they got a bump on that too. But coming down the pike is the Trump tax cuts of 2017 that went into effect in 2018 through now is going to sunset at the end of 2025. And there's a lot of things that are changing there. For example, the standard deduction is going to basically be cut in half. It's going to go from 29.2 to 16.6. So that's 13,000 drop right there.
Right.
The exemptions coming back though. Remember those back in the day when we had exemptions for the kids? And the child tax credit's going to go from $2,000 down to $1,000. The business side, a huge thing is the 20% qualified business income deduction is going away completely. So that's a huge deduction on the businesses, and there's going to have to be a lot of planning to make up for that in the future. So those are some of the things on my mind.
Yeah. And I think another item on that list, Jon, is the change to the estate tax, right? Where right now the threshold is pretty high, and that could go as low as $5 million, a little more, give or take, with the inflation adjustment. How should people think about that? Because I think that impacts a lot more people than where rates are right now.
Yeah, I mean, with inflation, people are making a lot more money these days, right? It's going to go from 13.61 million down to $7 million per person, per couple, or not per couple, per person. So 14 million combined. And that's there's a lot that you need to do to to not get hit by that. And
Yeah,
yeah,
we talk about this all the time with our clients where you know, as it stands right now, it's like a $26 million exemption. And so it's a really, really good problem to have, but not one that most people are worried about. But, you know, if I'm 65 years old and I'm right there in that retirement space and I've saved up $3 or $4 million, the rule of 72 says that every 10 years, if I'm making 7.2% interest, my investments are going to double. And so if I'm 65 and I've got a reasonable pension and Social Security coming out, and I've got, you know, let's call it $4 million in 20 years, that's a $16 million estate, right? And so if those exemptions hold, I'm now very exposed to this estate tax problem. And I think a
yep,
lot of people need to more appreciate how this is going to impact them, you know, as this goes. I mean, and there's an appetite in government to make this tax stick.
yep. And I mean, there's talk about making the yeah, a tax on just your wealth too. A lot of the uh, a few of the Democrats are talking about just taxing just your portfolio every year, just based off of your assets that you hold. Yeah, and
I
not
mean,
selling it. So that would be nuts.
Scott shows a chart on the national debt, right?
Yeah.
And Scott, walk me through the math on how that national debt thing was working.
Yeah, so it currently stands at around $33 trillion. That's trillion with a T. And the rate of growth and of change has just gone not quite exponential, but there's an inflection point when COVID hit where our national debt just exploded. And so that needs to be funded, you know, one way or the other. It could be through economic growth, it could be through increased taxation, it could be through inflation, or a combination of all three. But I think it's a virtual lock that taxes will be higher in the future. And I want to circle back on one thing with you, John.
Yeah.
Just on that estate tax, what is the highest estate tax rate that people would be subject to?
I mean, it can almost be 50% is the estate tax rate. It's high 40s. It's 45 is where it starts, and it goes up from there. So it's nuts. You'll lose half of your income.
Yeah,
Uh,
and to unpack that, I mean, you paid taxes your whole life, you paid capital gains on the appreciation, and
when
then
you
when
die.
you pass, there's an extra pound of flesh that's taken. So, you know, anything from a planning perspective folks can do to minimize or avoid that is super prudent.
And
Yep.
there are ways, you know, there are planning strategies and techniques. It's
Hmm.
stuff that I think a lot of people haven't spent a lot of energy um, worrying about over the last 5 and 10 years. But early in my career, this was a really big issue that we were exposed to. I mean, at one point, the estate tax exemption dropped to $1 million way early in the 2000s.
Yep.
And so there was a lot of energy that was people were applying back at that point. But it's something that we probably need to start paying attention to again.
Yeah, for sure. I mean, you can start to give money if you give at least at the $18,000 a year or less, then it doesn't count to your gifting over your lifetime. So start gifting money to your kids or whoever. Set up a trust. There's 101 trust that you can set up where you put the money away and it's not counted in your estate.
And
And
that gifting, that's an annual gift exclusion. I can give that $18,000 per beneficiary,
per
right?
person. So you and your wife could give, yeah,
Each
18,000
my
times two.
spouse and myself can give a $18,000 gift per beneficiary per spouse.
Yep.
Yep. So if we've got a
So
couple kids and a couple kids' spouses, we
yep,
can gift out quite a bit of money out of the estate.
you could gift
And
that
then I'm
pretty.
not paying tax on that gift, and they're not paying tax to receive that gift.
Nope,
Yeah.
nope. If you go over that amount, you have to file a gift tax return with the IRS, and that does count against your lifetime exclusion.
The lifetime
Okay?
exclusion.
So yeah,
Let me circle back, John, on talking about some of the adjustments. I know that there's not a lot of adjustments on tax brackets, but we have seen some numbers change. I want to hit on one of those. Social Security, the FICA kind of contribution maximum,
Mhm.
that number historically goes up pretty regularly, but we saw a pretty
Mhm.
big increase this year. It was at 146, and now in 2024, what did they jump that to?
168.6.
So
So
nearly
it's
nearly 169.
Mhm.
And I think this is kind of something that gets overlooked regularly by consumers, our citizens.
Yeah.
This is the amount of money that if we make up to that threshold, all of it is subject to paying a FICA tax. So our Social Security, we'll call it like a premium effectively, right? Where we're paying
Yeah.
money into the program, and then they keep raising that number. Last year, one of the common threads that we got a lot from clients was how grateful they were that we got a cost of living adjustment. It was substantial. I mean, it was almost 9% in a cost of living adjustment, and that gave everybody quite a bit more money to be able to keep up with this inflationary cycle. Simultaneously, they turn around and they increased the FICA limits by almost 13%.
Yeah.
You
Yeah.
know,
Almost 13.9%. So in this FICA, it's 6.2%. It's quite a big number. And then if you are an employer, you pay the other side of that too.
yeah.
So up to that amount. So it's quite a bit of money.
I mean, I think of it like a magic trick. It's sleight of hand, right? I mean, like pay
Yeah.
attention to this over here. Don't see what I'm doing over here.
Yeah.
At the end of the
9%
day,
here. I'll take 13, 14 more over here.
yeah. It's a great way to raise the tax base without getting people too worked up. But it's nonetheless, that's what it is. It's a tax increase.
Yeah, it is.
So
And then going back to what Scott's talking about, the debt, they're going to either have to increase this limit by a lot, or just get rid of the limit and just have everything be taxed to fund it, right?
yeah,
To
yeah.
get rid of our debt.
Yeah, and from my perspective, and there's a million different thoughts on this, but Social Security, in my view, is one program that they will find a way, and it will either be through increasing the full retirement age or increasing taxation, but they will find a way. So I think the likely outcome is a combination of some of those things, increasing the full retirement age, increased taxation, but I think one way or the other, they will find a way to fund it.
Yeah, I mean, as a pragmatist, they have to, right? I mean,
Yeah.
they're not going to pull the program off the shelf and say, never mind. I mean, we have a significant percentage of our retired population relies wholly on Social Security to maintain their basic standard of living. And if we were to remove that program, we would end up shifting an entire population into welfare. And if you look at the numbers on the administrative costs of the two programs, it's significantly more expensive to administer the welfare program than it is to administer the Social Security program. So just by way of being a pragmatist, I don't think that there's a chance they're not going to finance the Social Security program. They'll make it work. And to your point, Scott, there's reform conversations that happen on this issue regularly. And I mean, if you look at the full retirement age today at 67, that jumped from 65, which was when the program began in 1935, to 67 today in 2024. And during that same period of time, life expectancy obviously has changed to the tune of maybe as many as 15 years longer today than it was in the 1930s. So no, I don't think that we can make an argument that they're not going to change full retirement age for at least our generation here. So so talk to me about a little bit, John. I'm the other one that I always think is fascinating is IRMAA, right? Which is a tax. Well, it's a premium. We can call it whatever word we want to call it. It's a premium that we pay for our Medicare Part B and Part D, and we pay that premium based on our reportable income. Correct?
Yep. Based off of your your taxable income. So if it's less than 103,000 or equal, if you're single, right? Then no change at all on either Part B or Part D. If you're married, it's 206,000. Okay, less than or equal to.
Yeah.
But then once you go over that, greater than 206 to 258, it goes up by $70 a month on B, and then $13 a month on Part D. So it just goes up from there. And you got to watch this. And this is why, there's other conversations to mix your taxable income versus non-taxable. I know we're going to talk about the Roth conversion stuff. This can
Well,
play
this
into
is one
that.
that bites people all the time, where they'll do a big
Yep.
Roth conversion.
Yep. And then they get hit with this next year. Yeah.
Yeah. So let's talk a little bit about tax loss harvesting. This is an area that I think is an opportunity for people to find some tax savings and tax benefits, especially in retirement. And so Scott, give us kind of the 10,000-foot view of what tax loss harvesting means.
Yeah, absolutely, Paul. So within one's investment portfolio in a non-retirement account, you have winners and losers. You have stocks that are up in value, stocks that are down in value, and when those stocks get sold, if it's a loss, you don't owe taxes, and in fact, there's some tax benefits there. If you have a gain, you're subject to capital gains tax on those monies. And so with tax loss harvesting, what you can do is strategically sell some of those stocks that are down in value and realize the loss. That offsets future capital gains or current capital gains. And then IRS rules say as long as you wait 30 days to buy back that stock, you can buy the stock back and reset the cost basis.
So, so some opportunities here from a tax perspective, like in 2022, there was some pretty rough waters out there on the markets, and if we had stocks, now this doesn't work in an IRA environment. This works with what we call after-tax dollars, and so if we had stocks that had appreciated, significantly in 2022, some of those may have actually had a pretty significant loss in value. And if we were trying to say, look, we believe the market's going to come back, these positions are temporarily down in value, but we don't think that these companies like Amazon or Netflix are down and out, they're just temporarily being reset on the pricing, we would have an opportunity to say, what if we sold some of these positions and then within the wash sale rule, purchase them back again and take any of those losses? And John, how much of those losses can we capture and keep?
So, I mean, if you have capital gains, it'll wipe away all capital gains, but you can only carry over $3,000 a year of a loss.
On the income side, on the income tax side.
On the income tax side, yes. But I mean, it's unlimited if you have unlimited gains, right? So if you have $200,000 gain, yeah, wipe it out if you have losses on it.
And how long can I keep those and bank them?
You can bank them for up to 20 years. So it carries forward. Those losses carry forward with you for up to 20 years from when it happened.
Yeah. So that's a pretty phenomenal opportunity, from a tax savings perspective, is to work on that harvesting of the portfolio throughout the year. Do you guys see a lot of that, John?
Yeah, we see a lot of it. Yeah.
That's good.
On that side. So, and we see it carried over for many, many years on some of this. So,
yeah, that's really good. Another question we get a lot is on kind of Roth conversions. John, what's your take on kind of Roth conversions, pros and cons?
Yeah, let's go over the cons first. I like to go over that because I mean, you can get hit with the IRMAA stuff that that we've talked about, where your Medicare costs are going to go up because you're converting a ton of money in 1 year. You're going to pay a lot of tax, and you're only going to want to do that if you expect the tax rates to be higher now than they are in the future, right?
Right.
If they're going to go up in the future, you don't want to do that. Yeah. Or no, if they're going to go up in the future, you want to do it now. That's what I'm saying.
Right.
Yeah. Because the lower rates now are more beneficial to get that money and have it be taxed. And then in the future, you have tax-free income, which is great. So
one of my concerns that we deal with when we get to these conversations, because we have them regularly with clients, is there's kind of a runway needed in order for that to really work well. Because the benefit of a Roth is that the growth of the money is now tax-free. And so you want to have this compounded growth where you can look back and say, hey, look, this Roth that if I had let's say $150,000 traditional IRA, and then I rolled it into a Roth, and let's say that it ended up costing, depending on my income levels, just making our math easy, $50,000 to get that money out, and now that's all Roth money. That account, again, following the rule of 72, if I make 7.2% interest, will double in 10 years, and now it's worth $200,000, and I would have paid $50,000 in taxes, and now I have effectively $100,000 of gains that are tax free. But it took me 10 years to really see that benefit, right? And so that's the thing I sometimes wrestle with when we talk about these Roth conversions is, if we've got somebody who are, they're in their 50s, there might be some virtue there to say, hey, we've got time to be able to catch this, make this up, and have it look very attractive down the road. When someone's in their 70s, it gets tricky about whether or not this is going to be a long-term benefit to them.
Yeah, you need to have time to make up the tax that you're going to pay for sure. Yeah, because you lose that momentum because you don't have as much money to compound, right?
Right.
During that time. So I mean, yeah, if you do it early 50s, early 60s, it might make sense, but later on in life, I don't know if it does make sense. If it were me, yeah, I wouldn't want to pay all that tax. But yeah, there's a lot of different ways for IRAs that you can gift that money, and yeah, in a qualified charitable distribution from an IRA, right? You can pay charitable contribution from that. So.
And I think there's a fair amount of nuance here and situation specific things that need to be looked at. I've seen examples where an individual will have $2 or $3 million in an traditional IRA, and when they reach required minimum distribution age, their required minimum distributions are onerous, and they're locked into crazy high RMDs for the rest of their life.
Yeah,
sometimes there's a case to be made for Roth conversions there, but I think it speaks to, ask your advisor, speak to your advisor about your situation specifically. And, it's worth a kind of case by case analysis, but yeah, broadly speaking, the runway is super important to consider.
John, you hit on a really good point there that I want to maybe flesh out a little bit more on those required minimum distributions that are going to come out. We have options there. And one of those options is to donate those using a qualified charitable distribution to a charity, a 501(c), and then we're not responsible or required, rather, to pay or recognize that RMD on our front page of our tax return. That doesn't come in as income, correct?
Yeah. On the QCD side, you want to make sure and do this when you're at least 70 and a half. Because otherwise you can't do it. Before then, the IRS will not allow you to have that charitable QCD on your taxes. So
right,
yeah.
And that's kind of cool because we've got RMDs have been bumped, right, as of the Secure Act 2.0, but we still are eligible to use that QCD even earlier than the RMD is required, which is kind of nice. They let us have that.
Yep. You can exclude up to $100,000 a year on these QCDs, which is a huge number. So
well, especially I think a lot of people in our area kind of culturally are very generous, and so when they can almost like forecast the amount of money that they want to donate on a regular basis, then this becomes a really important planning tool. Right, where they say, hey, I'm planning on donating this year anyway, $10,000 or something. Then this can become because you don't have to donate all of it. You can donate part of it and then take the other part of it in income. So
yeah, and that's per spouse. So each spouse can contribute 100,000, so up to 200 per couple. So, I mean, that's a ton of money.
Yeah,
I don't see a lot of people contributing $200,000.
No, not a very common issue.
Yeah.
So John, maybe shifting gears a little bit, I think this is a topic of interest to everyone. You've been in this business a long time, and audits occur. People do get audited. What types of things should individual filers really be aware of as far as red flags that increase the likelihood that they would get audited?
I mean, phony deductions on their return is a huge one. So there's a lot of people that I see that they do their return on TurboTax, and they'll just at the top it shows you your refund that you're getting, and they just keep adding stuff to that to make the refund go up. That's not real. And when the IRS they use ratio analysis, and so when your ratios go out of whack, they will that'll trigger an audit for sure. On the business side, obviously, if you have a lot of deductions that outweigh your income, and you have no income for more than 3 years, that's a huge red flag. But on the personal side, it's a lot of these people doing their own tax returns that they just want a higher refund just because, and they're just doing it.
Two things, John, that were kind of like hot topics at the end of last year that I think a lot of people were asking about. One, the SALT payments. In your mind, legit, not legit?
Yeah, it's totally legit. I think there's only a handful of states that haven't passed this SALT deduction, and it's basically paying your state income taxes from your business and getting a deduction in the business. So you get a federal deduction for that amount, and it's basically prepaying your state tax. It's a legitimate deduction because the Trump tax cuts, they limited the SALT deduction to only $10,000 on your itemized deductions. And so this gets rid of that cap, and you can basically pay for your state income taxes and have you get a credit for on the Utah or whatever state you're in. And it's an amazing thing. You get if you're in the highest tax bracket, you get a 37% off coupon on just prepaying your state tax.
Yeah.
Which is nuts. Yeah.
So one that people shouldn't be concerned about when they hear about that is like, yeah, go ahead and take advantage of it. The other one that I hear a lot last year was very, very trendy was the ERC.
Yeah. In the ERC, that's really, I get emails almost every other day from the IRS about fraudulent claims of taking the ERC. So the ERC, you need to focus on, I mean, they shut it down. You can't even get it anymore because there's been so much money and so much fraud, because there's basically like salesmen going around just doing these claims and they're not even looking at. So there's two factors on an ERC. You got to have losses that you've lost money, and there's percentages that you have to meet on that, or you can identify a government shutdown, that your company was shut down by the government, and it has to be specific. A lot of people just think that, oh yeah, everyone in COVID was shut down, so I'm going to claim this for 6 quarters, even though maybe you might have been shut down for a couple of weeks. So, and people are doing this, and now they're saying, oh, you can pay 80% of it back and we won't penalize you. And that's nuts. The government's only asking for 80% of it back if you come forward and say that you shouldn't have gotten it. So that just goes to show you that there's so much fraud out there in this. It's nuts.
I saw people being kind of propositioned by, you said salesmen. They were pure. Yep. They had no accounting background at all. Nope. And I would ask these people when they come to me with this information, I'd ask my clients, like, who is this guy? And I said, how does he get paid? And he would work on contingency, where he would say, you're going to pay me back from your tax benefits. You're going to give me a percentage of that back. I thought, man, you guys got to just turn and run. These people are very, they're going to get in trouble if you keep, listening to these guys talk.
And some of them weren't even waiting to get the ERC to get paid. They would charge them either 10% or up to 20% of the amount that they were going to get in the ERC is just a fee.
Yeah.
And they made hundreds of thousands of dollars, and companies have made billions off of this.
Yeah.
So it's just low-hanging fruit. When people see low-hanging fruit, they find any way to get it. And don't trust those kind of people, in my mind.
Yeah, and in me and Paul's world, John, if it sounds too good to be true, it probably is. There aren't a lot of free lunches in life, and so I think that's a cautionary tale with taxes too. The code does permit some legitimate stuff to really get your taxes in a better spot, but the government's going to make their money at the end of the day, and if it sounds too good to be true, it probably is.
Well, and I think that's something that a lot of people don't appreciate. Taxes are self-reported, and just because your accountant says you can do it this way doesn't mean he's right or wrong, and the liability's on you. So at the end of the day, if the IRS challenges you and comes back and says, no, you didn't do that correctly, you're on the hook for paying back whatever you may have collected that was incorrect, plus potentially fines and penalties. So
Yep.
Yeah, so it's always good to work with reputable sources, obviously, and not just credible, but competent. So let's maybe round out the conversation. Best practices for charitable giving. We talked about QCDs a little bit. Any other thoughts out there for charitable giving in 2024?
Yeah, just know the limit went from 17,000 per person on the gifts up to $18,000. Okay. And we talked about that earlier. And then, I mean, if you come into a windfall of money, I mean, there's other ways that you could give to, or you can spread it out over years. But Scott and Paul you could reach out to them for those. I won't muddy the waters with that right now. But yeah, the QCD is amazing if you're at 70 and a half or older. And then yeah, just it's a red flag if you try to give more than what you make sometimes. But I mean, there's people that do that and don't get red flagged with the IRS if they have a ton of money, right?
Yeah.
They give it to a huge foundation. So yeah.
What about in-kind donations?
Yeah, in-kind donations. Yeah, stock donations. If you have appreciated stock that's gone up a ton, and you need to pay some charities, and you want to, that's a great way to give to charities. Because I mean, yeah, I'll have Paul.
Yeah, well, maybe I'll whiteboard this real quick. So we can kind of show the benefits of this. So if I have Microsoft, and let's say I purchased Microsoft for $100 a share, and this is what we call after tax or non-qualified money, right? So non-qualified or after tax money, and just make my math easy. Let's say I'm going to sell that today. The value of Microsoft is $400 roughly a share. Okay, so in theory, I've got about a $300 per share capital gain. Okay, and if I've held this for longer than a year, that capital gain is considered long term, and I would pay, depending on the income level, it could be as much as 20% of that capital gain. Oops. 20%. So in this case, it'd be right around $60. Okay, that I would owe in taxes to sell that share of Microsoft. And one thing that we can do is we can say, rather than do that, we'll just donate the entire $400, that share, straight to our charity. And if we donate that to charity, then we can deduct the entire fair market value. So the $400 gets deducted off of our taxes. And meanwhile, we didn't pay this $60 in capital gains. And so the benefit of this, the value of this, I mean, the deduction on that, John, I mean, depending on our income levels, I mean, we're talking about what, 30+% deduction on that, right?
Yeah.
For high wage in the higher margin brackets, and then another 20% in capital gains that we saved. So I mean, this is a very significant benefit that people can use for charitable giving, is donating appreciated after-tax stock positions.
Yeah, yeah. The only thing you want to make sure on stock too is you only get up to 30% of your adjusted gross income on this, and not 50 like cash. So you can't. So if you want to give a lot of money and you do it this way, and then you get limited on the back end, just know that you can only deduct 30% of your adjusted gross income on stock. But it's an amazing way. You don't have to recognize that income and then get the charitable deduction. You just get the charitable deduction without having to recognize that when you give it directly to the charity.
Right.
And the other caveat, John, it needs to be long-term in nature, right? It needs to be greater than a year old.
Yep.
Yeah.
Yep. Exactly.
Yeah.
Yeah. You can't have, yes. And normally you wouldn't have stock that goes up that fast, right?
Would be a good problem to have, but yeah, you're right.
Unless, you picked a winner.
And it works with more than just stock, right? I mean, any real property, any asset. So we've seen people use this with silver, right? Physical silver.
Yeah,
they can donate that, and
Yep.
any other appreciated real property can work on this same strategy.
Exactly. Yep.
And that works for any 501c3, right, John? Is that the criteria that has to be met? It needs to be a 501c3 designation to be a
It has to be a 501c3
valid recipient.
Exactly. Yep. Exactly. A lot of the GoFundMe things that people think is a gift, they aren't gifts.
No.
You're just giving, or it's not a donation. It's actually a gift that when you're giving it to them. So
yeah. And if
people,
you try to treat it like a donation, that's an easy way for the IRS to come back and say, no, that doesn't count. We're going to disallow.
Yep, that's a red flag. I
Yeah.
see that. There's a lot of people that still try to do that. Every year I get people saying, oh, I gave this person because their mom died or whatever. I was like, okay, yeah, that's
It's a
just
nice
a
gift. And you can keep doing it because it's a nice gift. Just don't
It is.
don't
Yeah,
treat it as a tax deduction.
Yeah, that's very nice of you that you did that. That's
Yeah.
awesome. But
Yeah.
it's not a tax deduction. Yeah.
Well, John, we sure appreciate you taking some time with us today. We always like to keep these meetings short and sweet so our clients can catch them during lunch and then move on. Hopefully this was helpful and impactful for everyone today who jumped on with us. I think in closing, we'll just say, look, this stuff is complex. There's a lot more to unpack on this subject than we're going to be able to give you the highlights on in a 30-minute conversation. So feel free to reach out to us. John and his partner Reed as well are a fantastic resource for all things tax planning and strategy and advice and obviously preparation. So everyone here with us today, thanks for joining us. And until next time, we look forward to seeing you again. Thanks, everybody.
Thanks.
Thanks, everyone. Thanks, guys.
Yep.